If I were to start fresh today, with just $10,000 in my pocket and zero investment experience, what would I do? This question comes up all the time. It's simple but powerful because how you allocate that first chunk of money can set the tone for your entire financial future. I recently hit a milestone, a portfolio value of $1.1 million. That didn't happen overnight or by chasing hype. It's the product of disciplined investing, smart diversification, and learning from every market cycle. Today, I want to share with you the exact blueprint I'd follow if I had to do it all over again, as if you were sitting right next to me. The core of the strategy revolves around four main pillars: broad market exposure through the S&P 500, targeted growth with technology ETFs, steady income and stability from dividend-paying stocks, and the safety net of cash reserves. Each plays a unique role in balancing growth, risk, and liquidity. Starting with the S&P 500, this index is often called the heartbeat of the American economy. It represents the 500 largest publicly traded companies in the United States, household names like Microsoft, Apple, Amazon, Visa, and Coca-Cola. When you buy an ETF tracking the S&P 500, you're essentially buying a tiny piece of each of these giants. It's like putting your money into a basket that's been tested through decades of economic booms and busts. Why does this matter? Because diversification reduces risk. Instead of betting everything on one company, you spread your investment across multiple sectors and industries. This protects you from catastrophic losses if one company or sector tanks. Historically, the S&P 500 has averaged annual returns between 7% and 12%. Some years it dips, sometimes sharply, but over the long haul, it's a proven engine for wealth creation. Among the popular ETFs tracking this index, SPY is the most traded and offers excellent liquidity, which means you can buy or sell shares quickly at fair prices. Vanguard's VU and iShares IVV are also excellent choices, often with lower fees that eat less into your returns. For beginners aiming to grow their money steadily, VU or IVV might be more cost-effective. Liquidity matters if you plan to be more active, but for most investors, minimizing fees is key. Now, a word of caution: many new investors fall into the trap of picking individual stocks early on, chasing the next big thing or penny stock. While the idea of owning a piece of a breakout company is tempting, it's risky and requires deep research. Without experience, you can easily lose money. I've been there myself, investing in random stocks like Honda or small caps that didn't pan out. Learning from those mistakes, I advise newcomers to stick to diversified funds until they understand the market better. If your risk tolerance allows and you have a long-term horizon, think 10 years or more, adding exposure to technology companies can supercharge your portfolio. The Nasdaq 100 index, tracked by ETFs like QQQ or the newer QQQM, concentrates heavily on tech giants: Nvidia, Tesla, Meta, Alphabet, Google, and Apple dominate this space. These companies innovate constantly and shape the future economy. Technology investments come with higher volatility. Prices can swing dramatically in response to regulatory news, product launches, or economic cycles. If you're someone who panics at market dips, you might want to limit your exposure here. But if you have the stomach for risk and the patience to ride out downturns, tech stocks offer superior growth potential over time. Choosing between QQQ and QQQM depends on your investment style and budget. QQQ is well established, highly liquid, but pricier per share. QQQM offers similar exposure at a lower price point, making it easier for small investors to start building a position without breaking the bank. While growth assets like technology ETFs are exciting, they don't pay dividends, which means you rely solely on price appreciation. To balance that, I recommend adding dividend-paying ETFs or stocks to your portfolio. These investments may not grow as fast but provide regular income and greater stability. Funds like SDY focus on companies with a long history of dividend payments, think Pepsi, Coca-Cola, Home Depot, and Waste Management. These mature businesses tend to be financially sound, generating steady cash flows and weathering economic downturns better than high-flying tech firms. When markets turn turbulent, dividend stocks often hold their ground better, offering a cushion against losses. Dividends also offer the power of compounding if reinvested. Even modest dividend yields can grow your portfolio substantially over time. Plus, regular payouts create a sense of progress and income generation, which is psychologically rewarding for many investors. Lastly, I can't stress enough the importance of holding some cash within your portfolio, typically 5 to 10%. Many investors overlook this, but having liquidity ready allows you to act during market pullbacks or corrections. When quality stocks trade at discounts, having cash on hand means you can buy more shares at better prices. Some brokers pay competitive interest rates on uninvested cash by automatically placing it in money market funds. For example, my brokerage offers nearly 5% annual yield on idle cash, a nice bonus that beats most savings accounts. How you allocate this cash depends on your comfort level. If market swings keep you up at night, lean towards a higher cash position for peace of mind. If you're more risk tolerant, you might keep cash to a minimum and stay fully invested. Let's bring this all together with some sample portfolio allocations for your first $10,000 investment. For a balanced approach, consider putting $4,000 into an S&P 500 ETF like VU or IVV, $3,000 into a tech ETF like QQQ or QQQM, $2,000 into a dividend-focused ETF such as SDY, and keep $1,000 in cash. Younger investors with higher risk appetite might tilt more heavily toward technology stocks, potentially allocating $5,000 or more there and reducing dividend and cash positions. Conservative investors seeking income and stability might allocate $4,000 or more to dividend ETFs, less to tech stocks, and hold a larger cash reserve. For simplicity, some investors prefer going all in on a low-cost S&P 500 ETF and maintaining a modest cash buffer. No matter what allocation you choose, the most important thing is that it matches your personal risk tolerance, time horizon, and financial goals. This is your money. Don't feel pressured to follow someone else's blueprint blindly. Markets will fluctuate. Companies will face challenges. But a thoughtfully diversified portfolio built on these pillars offers a resilient path to grow your wealth while. If you want to dive deeper into building a high-yield dividend portfolio or learn advanced strategies like covered calls, which I use myself to generate income on SPY and QQQ, I have more videos that break these topics down step by step. To wrap up, investing your first $10,000 doesn't have to be complicated or intimidating. By focusing on broad market ETFs like the S&P 500, selectively adding growth tech stocks, including dividend payers for income, and maintaining cash reserves for flexibility, you create a foundation that can serve you for decades. Remember, investing is a marathon, not a sprint. Stay consistent, stay informed, and keep your emotions in check. With patience and discipline, your first $10,000 can be the seed that grows into lasting financial security. If you found value in this deep dive, please hit like, subscribe, and leave a comment with your questions or experiences. Your support helps me create more content that empowers you to take control of your financial future. Thanks for watching, and I'll see you in the next video.